Hey, welcome back to the channel. I'm Amy and I'm happy to see you. I think one of the biggest mistakes traders make is assuming they need more information. More, in this sense, doesn't necessarily mean better. Another strategy, another indicator, another course, another YouTube video, another trader to follow, another explanation of market structure. They believe the missing piece is hidden inside something they haven't learned yet. But for many traders, the problem isn't that they don't know enough. The problem is that they haven't learned how to consistently execute what they already know. They don't have an information problem. They have an implementation problem. And until they understand the difference, they will continue collecting knowledge while repeating the same behavior. Today, I want to explain why more information may actually be making you a worse trader and what you should focus on instead. Part 1. Information feels like progress. Learning feels productive. When you watch a trading video, take notes, download a strategy, or add another concept to your chart, it feels like you're improving, and sometimes you are. But information can also become a hiding place. It allows you to feel productive without confronting the harder work. Waiting, following rules, accepting losses, managing risk, reviewing mistakes, repeating one process long enough to determine whether it actually works. Information gives you stimulation. Execution demands discipline. That is why traders frequently choose another video over another hour of deliberate chart review. Watching someone explain a winning trade is exciting. Reviewing 10 of your own premature entries is uncomfortable. One gives you the feeling of advancement. The other forces you to change. Part 2. The market doesn't pay you for what you know. The market does not care how many trading concepts you can define. It doesn't care how many strategies you have studied. It doesn't care whether you understand liquidity, order blocks, fair value gaps, market structure, volume, auction theory, or institutional behavior. You are not paid for recognizing vocabulary. You are paid for making good decisions under uncertainty. That means knowing when to participate, knowing when to wait, knowing how much to risk, knowing when the evidence is incomplete, and knowing when your original trade idea is no longer valid. A trader can possess an enormous amount of knowledge and still lose money because knowledge does not automatically become behavior. You may know that chasing price is dangerous and still chase. You may know that risk should remain consistent and still increase your size. You may know that you need confirmation and still enter before confirmation arrives. You may know that one loss means nothing and still revenge trade immediately afterward. The problem isn't always understanding. Sometimes the problem is obedience. Can you obey your process when the market gives you a reason to abandon it? That is the real test. Part 3. More information can create more confusion. Imagine that you're analyzing gold. On one side of your chart, you see bullish structure. On another time frame, you see a bearish order block. One indicator suggests momentum is increasing. Another says the market is overbought. A trader on YouTube expects gold to rise. Someone on social media expects it to collapse. You identify liquidity above price, an imbalance below price, and several possible levels where the market could react. Now you have more information. But do you have more clarity? Not necessarily. You may have simply created more ways to justify whatever you already want to do. This is one of the dangers of excessive information. If you collect enough concepts, you can always find one that supports your emotional bias. Want to buy? You'll find bullish evidence. Want to sell? You'll find bearish evidence. Want to enter early? You'll find a reason. Want to hold a losing trade? You'll find a level that might save you. At that point, information is no longer helping you make decisions. It is helping you defend impulses. Part 4. Complexity can hide the absence of proof. A chart covered in indicators, zones, labels, and predictions can look intelligent. But complexity does not automatically produce accuracy. Sometimes complexity simply makes it harder to admit. The market hasn't proven anything yet. At ICCLAB, we reduce the decision to a sequence: indication, correction, continuation. First, the market must indicate that something meaningful may be changing. That indication must do damage. It should break meaningful structure, create displacement, or materially challenge the side previously in control. Then the market corrects. The correction gives us an opportunity to study the response. Is the original move being accepted? Is opposing pressure returning? Is price holding the area it claimed? Then, continuation delivers the verdict. Continuation confirms that the indication was more than temporary movement. It proves that the market is willing to continue in the proposed direction. Without continuation, the sequence remains incomplete. No matter how many additional concepts you understand, they cannot replace missing proof. A fair value gap cannot complete an unfinished ICC sequence. An order block cannot turn a random candle into a valid indication. A liquidity level cannot guarantee continuation. More labels cannot rescue incomplete evidence. Part 5, the beginner's trap. Let's say a trader learns ICC. They understand indication, correction, and continuation. But after taking a few losing trades, they begin to doubt the process. Instead of reviewing whether they identified the sequence correctly, they start searching for another filter. They add an indicator, then a session rule, then a new entry model, then a different time frame. Then, someone teaches them a new liquidity concept. Soon, they are no longer trading one process. They are trying to negotiate between 6 different systems. When a setup wins, they don't know which rule produced the result. When a setup loses, they don't know which part failed. And because the process keeps changing, they never collect enough consistent evidence to evaluate themselves. This is strategy hopping disguised as education. The trader believes they are expanding their knowledge. In reality, they are repeatedly resetting their development. Every new system gives them temporary hope, but it also prevents them from mastering the previous one. Part 6. You probably don't need another strategy. If you already have a process with clearly defined conditions, you probably do not need another strategy right now. You need to answer harder questions. Can you correctly identify meaningful structure? Can you distinguish displacement from ordinary volatility? Can you wait for the correction without chasing the indication? Can you wait for continuation without predicting it? Can you define exactly where your trade idea becomes invalid? Can you maintain consistent risk? Can you avoid trading when the sequence is incomplete? Can you take a valid loss without changing your entire system? Those are not information questions. They are performance questions. And performance only improves through repetition, review, and correction. You cannot think your way into discipline. You have to practice disciplined behavior until it becomes familiar. Part 7. Build depth instead of width. Most developing traders pursue width. They learn a little about many things: a little market structure, a little liquidity, a little psychology, a little supply and demand, a little volume, a little price action. But professional development requires depth. Choose one market, study how it moves, choose one session, understand its behavior, choose one framework, define its conditions, choose one risk model, apply it consistently, then collect evidence. For me, that market is gold. The framework is ICC. The question is not, how many ways can I analyze this chart? The question is, has gold completed the sequence required to earn my participation? That question creates boundaries, and boundaries are what protect you when emotion begins negotiating. Part 8, the execution audit. Before learning another concept, perform an honest audit of your last 20 trades. For every trade, ask, was there a meaningful indication? What structure did it damage? Was there clear displacement? Did I wait for the correction? What did the correction reveal? Did continuation actually confirm the direction? Did I enter according to my rules? Was my risk predetermined? Did I follow the plan after entering? Would I take this exact trade again without knowing the outcome? Then separate the trades into 4 categories: valid trade, good execution; valid trade, poor execution; invalid trade, profitable outcome; invalid trade, losing outcome. That 3rd category is especially important. A profitable trade can still expose a serious execution problem. If you entered without proof and happened to make money, the outcome does not validate the decision. Profit tells you what happened. Process tells you whether your participation was justified. Part 9. Create an information freeze. Here is a practical challenge. For the next 30 days, stop adding new trading strategies. No new indicators, no new entry models, no changing systems after a loss, no collecting random concepts that you have no plan to test. Instead, spend those 30 days doing 4 things. First, study one framework. Second, replay and annotate historical examples. Third, document every execution decision. Fourth, review your rule violations separately from your profit and loss. Your goal is not to prove that your current process never loses. Every legitimate trading process loses. Your goal is to determine whether you can recognize and execute the process consistently. You cannot accurately judge a system you keep changing, and you cannot build confidence in rules you repeatedly violate. Part 10. What you actually need more of. You may not need more information. You may need more patience, more repetition, more screenshots, more chart review, more honest journaling, more time spent waiting for the full sequence, more acceptance that missing a trade is less damaging than inventing one, more willingness to say, I understand what I'm seeing, but the evidence is incomplete. That is not ignorance. That is maturity. A mature trader does not participate simply because they recognize something. They participate when the recognized condition has been confirmed. The trading industry constantly tells you that the next piece of information will finally make everything click. Sometimes new knowledge is necessary, but information should solve a clearly identified problem. It should not be used to escape the responsibility of execution. Before buying another course, adding another indicator, or studying another strategy, ask yourself, have I truly exhausted what I already know? Have I executed it consistently? Have I collected enough evidence to evaluate it? Or am I searching for more information because following my current rules feels too difficult? You do not become a better trader by knowing everything. You become a better trader by knowing what matters and doing it consistently. Simplify the chart. Define the evidence. Wait for the sequence. Execute the process. Review the behavior. Then repeat. The market does not reward the trader with the most information. It rewards the trader who can make the best decision with the information that matters. No proof, no trade. If you want to learn how to trade gold using indication, correction, and continuation, join us inside ICCLAB. Until next time, remember, the market must earn your participation, and if it's not ICC, it's not a trade.